All right, let's dive right in. Today, we're looking at a framework that's all about transforming financial management, taking it from a chore that just looks at the past and turning it into a real strategic powerhouse for the future. So, let me just start by asking a pretty blunt question, especially for you finance leaders out there. Are you trying to steer your institution through this crazy, fast-moving world by staring only in the rearview mirror? It sounds a little nuts when you put it that way, right? But it's a super common problem, and it's exactly what we're going to tackle. And this really lays out the core battle we're talking about. Over on the left, you've got your traditional finance department. It's always looking backward, obsessing over why last month's numbers were off, and a lot of the time it's stuck in its own little silo. But on the right, that's where we want to be, strategic finance. It's forward-looking, it's all about planning for different scenarios, and it's woven into the very fabric of the entire institution. So yeah, that leads us straight into what we're calling the rearview mirror problem. The analogy is just so perfect. Trying to run your finances with old school methods today is exactly like trying to win a race by only looking at the track you've already covered. It's not just going to make you lose, it's actually pretty dangerous. Let's break down those pain points a little more. We're talking about an over-reliance on these rigid annual budgets. So much time is spent just analyzing variances, explaining why things didn't go according to a plan that was probably outdated the month after it was made. This whole approach just isn't built for the world we live in now. It forces the finance team to be reactive, always explaining the past instead of helping to create the future. Okay, so how do we get out of that trap? Well, that's where this forward-looking framework comes into play. If the old way is the rearview mirror, you can think of the Kohl Strategic Management Framework, or SMF for short, as your institution's GPS, helping you navigate what's ahead. So what is this SMF, really? The keyword here is practical system. This isn't just some high-level academic theory. It's a real, hands-on system that gives you a single, integrated view of your finances, but a forward-looking one. It connects your big picture strategy directly to your day-to-day operations and capital decisions. And what's the end game here? It's a complete identity shift. The whole point is to elevate the finance team from being seen as a back office, bean counting function to being an absolutely essential strategic partner who has a real voice in guiding where the institution is headed. All right, let's get into the nitty-gritty. The first big thing the SMF does is connect your products directly to your profit. It's all about creating total, undeniable clarity right from the ground up. I mean, it starts with a pretty basic idea that we can all agree on, right? Knowing which of your products actually make money, that's obviously a good thing. That's just Finance 101. But here's the million-dollar question. Just because a product line is profitable on average, does growing it actually add real value to the institution? Or could that growth be slowly, quietly eating away at your overall returns without you even realizing it? To figure that out, the SMF uses this really powerful metric called Marginal Economic Contribution, or MEC. Now, unlike your standard metrics, MEC is all about looking forward. It measures the extra value that one new account brings in after you account for the capital and operational costs to support it. So think about it. It's not just asking, is this new loan profitable? It's asking, is it profitable enough to be worth the resources we're putting into it? This is how you find truly smart growth. So how does this actually work? It all starts at the very bottom, at the most granular level, looking at the profitability of one single product, one single account. And it doesn't just use some old blended average. It measures that product's true contribution to the bottom line using that forward-looking engine we just talked about, MEC. Then all of those individual, super accurate insights get rolled up. So now you have a crystal clear picture of how profitable your entire portfolio really is. And here's the magic. This whole chain connects all the way to the top. You can now draw a straight line from your decisions on the ground floor to your biggest enterprise-level goals, like return on assets. It completely closes that gap between what you say your strategy is and what you actually do. Now, being strategic isn't just about profit. It's also about mastering risk. And that moves us into how this framework helps you go from being reactive to proactive. It's all about getting the tools to model the future so you can manage risk before it manages you. Think about how most institutions handle asset liability management, or ALM. It's almost all focused on these hypotheticals, right? What happens if rates go up by 1%? What if they go down? It's all about what might happen in the future.
But the SMF takes a totally different angle. Before you worry about the future, it helps you quantify the interest rate risk that is already baked into your balance sheet right now, today, based on the actual business you have on the books.
And the core tool for this is something called funds transfer pricing, or FTP. Let's break down how it works. First, it assigns a true market-based funding cost to every single asset and liability you have. Second, once you know the true cost, you can measure the actual spread or profit on every single product. Third, by doing that, you can quantify your earnings at risk. You know exactly how much of your profit is exposed if rates change. And finally, with that hard data, you can make and justify smart, strategic decisions about hedging.
And to make all of this planning really work, you need one more piece: time-driven activity-based costing, or TDABC. Forget static line item budgets. TDABC gives you the real-world operational cost drivers behind the numbers. This lets you build a dynamic, living model of your business, which means you can run what-if scenarios incredibly fast.
So what does this all add up to? Well, it's the new face of strategic finance. We are talking about a complete reinvention of the finance function, from a scorekeeper on the sidelines to the central driver of strategy. And this quote just says it all, doesn't it? When you have these kinds of tools and you adopt this forward-looking mindset, finance absolutely earns its seat at the strategic table. It's no longer just reporting on what happened. It's actively helping decide what happens next. And look, if you only take one single thing away from our discussion today, please let it be this. The goal of a system like this is not to create prettier charts or more detailed spreadsheets. The entire point is to drive better, smarter, and more profitable decisions throughout the whole organization. So I'll just leave you with this question to think about. If you had this kind of clarity, this direct line of sight from your products to your profit, from your current risk to your future strategy, what better decisions could your institution start making tomorrow?